But one farmer says, seems to me there was a tea party in Boston that was illegal too.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold.
We shall seek to establish and maintain a dollar which will not change its purchasing and debt-paying power during the succeeding generation.
As anguished shrieks rose up from the floor of the New York Stock Exchange.
Government credit and government currency are really one and the same thing. A reserve of gold and a small reserve of silver.
Why do central banks hold it?
Well, it's a form of reserves.
Why don't they hold diamonds?
Well, it's tradition, long-term tradition.
Hey, good evening. Welcome back to the Junius Small P channel. We've got some good articles, some very boring articles to go over this evening here on the most boring channel on YouTube. But good information regarding gold and future prices, what's going on in Europe, and a lot of activity in the gold market. Before we get going, just a quick reminder, we just put this up yesterday. I learned about Teespring from Salivate Metals channel. I've heard about it and took a look, and it looked like they had some quality shirts, good fabrics, good garments, things like that. And I figured a lot of you might enjoy wearing the Junius Small P round, the symbol with the face of Marcius on it, as well as the emoji symbol on the reverse. So there's some shirts and some sweaters, sweatshirts for both men and women, if you are interested. Or to quote Miss Maltby, the most boring outfit you could ever wear. So before we get into the meat and potatoes of more recent news, let's take a step back to this article from July 25th, 2019 by Thomas Luengo. Gold is calling out the insanity of the European Union. It is also calling out the insanity of the global economy. But really, it's all about the euro at this point. This is going to be from the article, Europe is Dying on a Cross of Gold. Since breaking through the post-Brexit high of $1,375 per ounce, gold has pushed higher. Yes, it's been volatile. Yes, the forces of control keep trying to stuff gold back inside the box, as it were, and they keep failing. Last week's price action was impressive, even if the close was less than stellar. In the world of financial commentary, everyone is looking for proximate causes for spikes and dips, but most of that is simply noise. I don't care why gold touched $14.50 last week, only that it did. And let's take a quick look at the weekly chart he put up back in July. There you can see gold starting its uptrend, hitting that $14.50 mark, and we all know where it went from there. The political landscape in Europe is, at best, fractious, and that is always reflected in a currency. This is especially true in what Martin Armstrong calls a non-core currency like the euro. If the above charts don't convince you, then this one should. And this is gold in euros monthly chart. If you remember, the other night we put up some gold in euros charts, and you can see it hitting new highs with gold breaking out priced in euros.
The stampede out of the euro, given Germany's increasingly precarious economy and the slow-motion implosion of Deutsche Bank, is just beginning. Brexit of some form not to the EU's liking is on the table lest Nigel Farage becomes Prime Minister. Angela Merkel is on her last legs, physically and politically. France wants to punish the English for Brexit, and Italy wants out of the euro. And the U.S. is leaning on everyone not to get off the train of any of the post-World War II institutions and rules, the IMF, NATO, the European Union, etc. That project is failing as well, but not today. Weaponizing the dollar today will result in its destruction tomorrow, but for now, the dollar is still king and it is looking ready to push up alongside a resurgent gold to crush the unsustainable euro.
The riots you hear in the background of bells inside of little bouncy balls is none other than the anti-government kitty, the ANCAT, who tends to harass me as we make videos and would like to offer her input as well. Central bank gold agreement dead at 20. Capping leases drove gold bull more than sales cap. Thursday, this week marked the 20th birthday of the central bank gold agreement, writes Adrian Ash at Bullion Vault. It also marked its sad demise. Only a few people noticed its passing, and not us until reminded, marking a sorry end for, quote, one of the landmarks in the gold market in our generation, unquote, as analyst Timothy Green said at the CBGA's birth in September 1999. Humming Eleanor Rigby is appropriate because indifference was all that kept the agreement alive for its last 10 years when the signatories renewed it twice to no purpose. Why bother? Central bankers hate making a choice or a headline if they can help it, but they hate even more selling gold when prices are high, and they'd rather chew glass than sell when their currencies and financial markets face chaos. Quite the reverse, in fact. Now take a look at this chart he includes. Official Sector Global Gold Demand 2019 Forecast. Net demand is the thicker bars in tons, left axis. Annual average price, US dollars per ounce, is the thinner line there. You can see from 1998 till now a dramatic increase in the gold price in US dollars, and starting in around 2008, moving on till 2010 when the price really spiked, the demand. Now this is something to pay attention to because we've seen a change in central bank attitude and behavior towards gold. Their demand for it is increasing dramatically.
Any sales cap, which was what the CBGA agreed, became redundant when Western selling ended amid the global financial crisis in 2009. So too did any pretense of wanting to defend Western currency values or needing reserve assets to do so, replaced by bailouts, QE money creation, and near zero to negative interest rates. Together, this has revived a strongly symbolic role for gold among the public, shown by grassroots campaigns to bring home our gold. It has also seen a surge in emerging market nations buying gold to hedge those Western reserve currencies under attack from their own issuers.
That agreement, first signed on the 26th of September 1999 and renewed every 5 years since, was in fact the unwanted child of what was, frankly, a sympathy shag between two misfits in a dark, forgotten corner of the party to end all parties when the 20th century ended. European central banks were stuck with piles of unfashionable, unyielding bullion. They just wanted to make a little money from their gold. Gold mining bosses wanted to do the same from their underground stockpiles. So with prices falling all through the long boom of the 1980s and 90s, how about paying the central banks a small rate of interest to borrow some gold, then sell it today before prices fell further, and return it from new production in future? Yes, how about hedging that gold mine production? Us again, hedged by borrowing and selling. Well over 1 year's full output global mine production set a run of new records even as prices kept falling. But central banks as a group had lent out half as much again, giving speculators perhaps 1,500 tons to play with.
Indeed, when the UK Treasury finally joined the selling in May 1999, announcing it would start auctioning off more than half the nation's reserves that July, more than a fifth of the UK Treasury's own gold was out on loan according to Bank of England, potentially helping short sellers front-run Gordon Brown's sales with gold from the very same pile. Shocked by the UK's willful, if not vindictive, announcement, the gold market price cratered that spring. It sank to set 18 fresh 20-year lows inside 3 months, losing 10% between the day of Brown's press release and the start of his sales. That cost the UK Treasury nearly $43 million on the first 50 tons sold, compared to gold's average $19.99 price before his announcement.
Brown's down, and many of the British viewers and UK citizens are very familiar with this bit of gold history. I've shared with the channel my personal experience with the Brown's down period when gold was $256. I think that's the low, $256 US dollars. And I remember working for my dad, and getting my paychecks from construction at the time and going into places to purchase bullion and being able as a teenager to purchase 1, 2, or more 2.5 ounces of gold at a time as a youth. And that, unheard of. I mean, you can't do that today. No young man can get a paycheck from shoveling cement and sand and go buy himself 2 or 3 ounces of gold at the end of the month. It's just not possible with these current prices on gold. But that is, again, history. Hopefully Miss Maltby's voice is as boring as mine. I don't want her to make this channel any more exciting than it has to be. So I think she's got a nice boring ring to it. I think everyone would agree. She's just as equally boring as I am. Central bankers across the channel were aghast. What was London thinking? Little Junius Maltby was also aghast. However, as a teen, I had no idea who Gordon Brown was, and I could not begin to tell you why gold prices were dropping and why they were the prices they were at the time. However, I did check on them frequently. I just didn't know what moved them. And what could they do to support the gold price as they continued selling gold from their massive but now devalued holdings? In the interest of clarifying their intentions with respect to their gold holdings, the undersigned institutions make the following statement. Now look at this. 1. Gold will remain an important element of global monetary reserves. 2. The undersigned institutions will not enter the market as sellers with the, it's crossed out, exception of already decided sales. Number 3. The gold sales already decided will be achieved through a concerted program of sales over the, and it's redundant here, they cross it all out, will not exceed approximately 400 tons, and total sales over this period will not exceed 2,000 tons. Number 4.
Looks like it says, the signatories to this agreement have agreed not to expand their gold leasings and their use of gold futures and options over this period.
Oh, we wish. Number 5. This agreement will be reviewed after 5 years.
Crossed out.
Signed as an aside at a long scheduled meeting of the IMF in Washington, that first central bank gold agreement of the 26th of September 1999 shocked the market even harder than the UK's sales decision 4 months before. The next morning, gold made its sharpest one-day jump since 1982, starting a 2-week gain of 25% that has yet to be beaten. Oh, we will see it again, my friends. Glancing back, you might think that the sales cap put that floor under gold prices. Lots of people still do, because it cleared the uncertainty and squashed the rumors about how much extra gold central bank selling would add to world mining supply. First agreed among the 15 signatories at 400 tons per year, the sales cap was raised another 25% at the CBGA's 2004 renewal, but trimmed back to 400 tons in 2009. Meantime, gold prices enjoyed a relentless decade-long bull market. But the sales cap was only one half of the agreement. The central banks involved also promised not to lend out any more gold. I think they mean onto the bull market, but they left a word out there. And hindsight says that was what really changed the dynamics. What cannot keep rising tends to fall back. So when central banks capped their gold lending at 1999's peak, the shock first took one of Africa's largest miners and heaviest hedgers to the brink of collapse. It then saw the world's gold mining sector as a whole move and then scramble to close out their forward sales and other short positions by buying back the metal they had already sold. And I remembered in an area I used to live in years ago, several gold mines shuttering during this time period, and people who worked for those mines being laid off.
So take note that here at the end of September 2019, gold prices have risen $161 per ounce across the third quarter in 2019 from quarter two's daily average. That's the largest quarterly gain since the current US dollar price peak of 2011's quarter 3, and the 8th largest quarterly rise in percentage terms so far this century at 12.3%.
That's actually impressive statistic. I did not know that. The 8th largest quarterly rise in percentage terms so far this century, 12.3%. That is impressive. And if you look back over the last decade and a half or so, just looking at the yearly gains in gold are quite impressive. Remember what we've told you in the past. If they were just a stock or a mutual fund or some other investment vehicle, and you took the word gold out of it, no one knew what it was, you just showed it the performance and the percentage gains on the year, it would be looked at favorably by many mainstream individuals. But as soon as they find out it's gold, then, of course, they talk disparagingly about it. But we'll continue here. All the gold still left in European central bank vaults and now free of any sales caps or leasing limits continues to pay them no interest meantime. Nor does the gold now piled up in the foreign exchange reserves of number 1 gold mining nation China or number 3 Russia. Well, not unless they can find someone wanting to borrow it for a small rate of interest, that is. Be Bold and Go for the Gold by Stuart Thompson. Now we're just going to cover a couple highlights from this article rather than read the entirety of it. However, you can always feel welcome to pause and read every word if you so choose.
As if they're not bored enough.
As if you're not bored enough, yes. However, this is the meat and potatoes of it here is, now they know the Fed stands ready to do whatever it takes to provide liquidity to markets, regardless of how inflationary that might be. Trump also stands ready to act. He's the most pro-markets president in a long time, and arguably in the history of America, so they say. Unlike Obama, he's not afraid to use the power that he has and to use it preemptively. Trump will be the one on the phone with the big bank CEOs in a heartbeat if there's even a hint of a major stock market decline. Of course, we all know it is beyond the power of the president to do anything about the market. The Dow versus gold ratio chart. You often hear of the Dow-gold ratio. It appears to be a great time to sell some stock market holdings and buy gold with the proceeds. Yes, that is something I would tell any of my friends. The U.S. government is caught in a trade quagmire, has horrible demographics, a peaking business cycle, and government spending and debt are rising relentlessly. Trump wants QE and negative rates. We've talked about that recently. Powell tried to hold the line, but when central banks take on governments, it's the governments that win. Trump might not get all that he wants, but he'll get a lot of it, and that's great news for gold. The bottom line, from a technical perspective, gold is the asset of choice now. From a fundamental perspective, it's the asset of champions. And from a Junius Small P perspective, it is the only way to preserve dynastic wealth. I often like to use some of the best information and save it for the end of the videos. That way, the people who don't want to stick in the time and stick around, well, they get to miss out on the good stuff. This article is Gold versus Paper Money. Production Cost is a Good Indicator of Real Value by Steve St. Angelo.
The U.S. Treasury printed another $243 billion worth of paper money in 2018, with the majority being issued as $100 Federal Reserve notes. What's interesting is that the reserve banks estimated the number of notes they were going to remove from circulation and destroy accounted for 75% of the U.S. Treasury 2018 print order. However, according to the federalreserve.gov website, the currency in circulation in 2018 increased by approximately $100 billion.
Nice, quick, boring chart to look at. U.S. total value currency in circulation. 2017, $1.571 billion. 2018, $1.672 billion. So out of the $243 billion in new printed Federal Reserve notes in 2018, only $100 billion were used to increase the total currency in circulation. But we also must take into consideration the stockpile of new notes sitting at the Federal Reserve banks besides the new 2018 printed notes. Either way, the U.S. Treasury printed $243 billion in new Federal Reserve notes last year. Do you know at what cost? Well, let's first look at the number of notes printed in each denomination. And there you can see the chart. And what I want to get to here is the number of $100 bills and how it is rising because the currency is worth less and purchasing less. That is the only excuse. It's the very excuse. I mean, you've seen the $100 trillion note. You've seen the $1 billion notes, the Zimbabwe currencies, the Weimar currencies. You've seen what happened in Venezuela. Are we moving in that direction? Some would say quite possibly that we are. Remember when you used to be able to purchase a steak dinner with $1? Yes, a silver dollar, that is. How often do you actually pull a dollar bill out of your wallet and purchase anything of meaning besides a pack of gum or a candy bar? And I don't even think you can do most of those anymore with a single dollar. As currency becomes less valuable and purchases less, you will see the lower denominated notes fall out of circulation. They're just not used or utilized. It's the very reason that they're getting rid of or trying to get rid of the U.S. penny. It just doesn't purchase anything. It's an encumbrance at this point. Unless, of course, it's a pre-82 penny made of real copper, and then you have some real value to it there.
Oh, while the U.S. Treasury printed 2,163,000,000 notes in $1 bills, they produced 1,753,600,000 of $100 bills at a total face value of $175.4 billion. Thus, the $100 bill accounted for 72% of the value of all the Federal Reserve notes printed in 2018. And if we look at the cost to produce these Federal Reserve notes in 2018, it was $800 million. A part of the $800 million figure is for removing and destroying the old bills. Now that we know the cost to produce paper money, how does that compare to gold? Global gold production was estimated to be approximately $136 billion last year. We arrive at the figure by multiplying 107 million ounces of gold production by the average gold price of $1,268.
If we assume a conservative 90% total cost of production for gold for 2018, my estimate based on research, then it would equal $122 billion to extract, mill, and refine 107 million ounces. However, it only cost $800 million for the U.S. Treasury to print $243 billion in new Federal Reserve notes. Thus, the total cost of printing is 1/3 of 1%. So if it costs 0.3% to print new paper money, what's the real value? I am not saying the value the U.S. government states the Federal Reserve notes are worth, but if you had to sell them as paper scrap, how much is paper scrap worth? On the other hand, what if you took in an ounce of gold to a reputable dealer or pawn shop? How much would they give you for your 1 ounce scrap of gold? Well, today around $1,500. They would likely buy it very close to the gold spot price, including their premium for doing business. Furthermore, you will notice that as paper money loses value, the look of the bill goes from classy to gaudy. Very true. Now, before we look at some of the bills he included in this article, I went and got this image here. This is a $20 bill from 1922. Just take a look at it. What do you see? In gold coin, payable to the bearer on demand. We've covered the history of the U.S. economy many times in different videos. We've covered the executive orders, the Federal Reserve Act, the Gold Confiscation Act. We've tied it all in to what we see happening today. Now just remember, this was a $20 bill at the time, and it would exchange for approximately 1 ounce of gold, a gold double eagle, a $20 gold coin. You could go to the bank, you could hand them this bill, and they would hand you a gold coin. That is today holds approximately, 1,500. I know they're a little bit less than a pure troy ounce, but they hold approximately $1,500 in gold. Now look at the top note. There's a $100 gold certificate backed by gold. Imagine being able to take that bill in, a $100 bill, and taking in receipt 5 gold coins, 5 double eagles for one $100 bill. Do the math on that. What is that? 5 times $1,500 today. What is that? Help me out.
That's $7,500.
$7,500 in gold today. And below that you see the $100 bill, Federal Reserve note, 1963. Of course, you can't take that bill in to get any gold. As we move on and America progressed, we move towards honk honk, welcome to clown world. $100 bill, Federal Reserve note, 2003. Above, and there you see the 2009 version as they start to hit it with different colors and inks and clown fonts, and just it's a joke, really. As the US $100 bill transitioned from a gold certificate to a Federal Reserve note, now backed by $22 trillion in debt,
Plus.
the look of the currency resembles more and more like monopoly money than real money. If you look at the little yellow 100 numbers printed all over the place to the left of Benjamin Franklin's face, it almost looks like a child stamped those. No, it's okay. It is. It's laughable. It's laughable. Over the past 2 decades, the percentage of $100 bills to the total currency in circulation has risen from 65%. This is important, ladies and gentlemen. 65% in 1998 to 80% in 2018. Think of that. The percentage of $100 bills as being part of the total currency in circulation. It's rising dramatically, which means 80% of the value of currency in circulation right now is $100 bills. One vital statistic he's leaving out is the percentage of feces and cocaine and drugs that is embedded in paper money here in the United States. And it's good because it really is a real representation of what America is. Feces, drugs, degeneracy, debauchery, corruption, crime, and just fake paper money. It's everything. It's fake. Just like us. Just like the nation we are in. Lastly, the US dollar will come under serious threat as the global economic system starts to unravel when the lack of global oil production, growth, soon declines, can no longer prop up the massive debt. At that time, the cost to produce money will offer a clue as to which form of money will be the ultimate protector of wealth. And you guys know the answer to that.
Don't expect gold prices to weaken much with the US dollar doomed. It's the title of this next article. Gold has been a big winner so far in 2019. Today, gold prices are up about 27% on a year-over-year basis. If you've been reading The Dispatch, you may not be surprised by such a performance. Earlier this year, I told you 2019 could be the start of the biggest gold bull market in history. I'm not talking about a typical gold bull market. This gold bull market is riding a huge, unstoppable trend. That gold is being remonetized and is returning as money. As I explained then, author of the article, one of the biggest reasons is the Federal Reserve's reversal from a policy of tightening to pumping out more easy money. The Fed's board members are not in the habit of admitting there's ever anything wrong with the economy. Acknowledging they have no control over the situation or that things can go off the deep end is not an option. But the recent rate cuts were just that, an admission of weakness. Why else would you need to cut rates if this is the greatest economy ever, as Trump has claimed? The gold bulls realized this and sent gold soaring right through the psychologically significant $1,500 level last month. Gold has decisively broken out of its 6-year trading range.
Aside from the Fed's return to easy money, there's another significant catalyst for gold prices. Central banks bought a record 651 tons of gold in 2018. It was the highest level of net purchases since 1971, when Nixon closed the gold window, and it's a 75% increase from 2017. Now, why do you think this isn't making huge headlines anywhere? It's not something you're seeing anywhere. I mean, this is not the type of information that's being transmitted over the wires. Countries like Russia and China are buying gold to reduce their reliance on the US dollar and exposure to US financial sanctions. Last year, Russia notably dumped $101 billion worth of US treasuries, and according to the World Gold Council, it replaced much of it with gold. The country's reserves have quadrupled in the last decade alone. Russia is now the 5th largest holder of gold in the world. Russia and China have continued their buying into 2019. I don't see any signs that either of those two countries will slow down. I expect the opposite. Other nations like Iran, Turkey, and Venezuela use gold for trading in energy and other goods to bypass U.S. restrictions and sanctions. All this is accelerating the trend of gold's remonetization. Despite the recent spectacular performance, gold still has an enormous upside. Remember, the price of gold is nowhere close to its all-time high. There you can see the price of gold is still about $400 below that high we saw back in 2011. And it's always nice when a former Fed chair comes out saying that things are not as good as everyone else is claiming they are. And it's always nice when they're not sitting in the seat, because they don't take any responsibility for the actions they took that brought us to this point, because we all know the delayed economic reactions of Fed decisions. So much of what we see today is secondary to Janet Yellen's behavior as the Fed chair, but we'll let that go. Obviously, we've covered a lot of material tonight looking at gold, its flows, its behavior with central banks, U.S. dollar creation. It all points to basically the same theme here that we've covered on the Most Boring channel on YouTube. There's a sea change occurring. There are storm clouds brewing on the horizon. And gold is that lifeboat many are looking for when it comes to financial and economic stability and preserving the wealth that they've worked for all of their lives. Or perhaps you're just starting working. Maybe you're a paper boy. You've gotten your first paycheck. You're wondering what you need to do with some of it as far as savings. Well, look no further than perhaps some silver. If you're a well-paid paper boy, maybe you can get yourself a 10th ounce of gold for around 150 or 160 bucks and start your journey towards saving in precious metals. Because obviously the news is pointing in a direction of economic uncertainty going forward. That'll conclude tonight's long 32-minute video. Half of you are probably asleep. And to the 4 of you who are still tuned in and still actually watching this at this minute mark, thanks for being here. Don't forget to like, share, subscribe, and if you want to wear a Junius Maltby shirt, go pick one up. I'm going to order mine soon because I too have to pay for them, and I would like to see what they look like. I'd like to see what the quality of these shirts are. If there's anything on there that you want that you don't see, let us know, and I'll try to get it up there. Someone already requested a mug with the emoji symbol, so I'm going to work on that. I'll get a mug.
I think that's a good idea. Drink out of that mug as the world falls apart around us.
Yeah, I definitely like my coffee in the morning, and I wouldn't mind looking at the word that represents the first time humans wrote the word freedom. So I'll definitely be getting the mug up there. Maybe I'll go do that right now as this video is loading. All right, have a good night. Thanks for being here.